welcome all of you to the Communique for our 97th Monetary Policy Committee meeting that held between yesterday and today. The Monetary Policy Committee met on September 18th and 19th, 2014 with all the 12 members in attendance. The chairman welcomed the new member representing the board of Central Bank of Nigeria, Mr. Stanley I. Lawson, to membership of the committee. The meeting held against the backdrop of the increasingly limited choices for monetary policy, particularly in the emerging market and developing economies, tapered recovery in the euro area coupled with the social and political tensions in the domestic and global environment, some of which have had fundamental impact on domestic macroeconomic management. The committee reviewed key developments in the global and domestic economy up to the middle of September 2014 and the outlook for the near term. The committee noted the slow global growth prospects as the IMF in July marked down its projection by 0.3% to 3.6%, reflecting weak economic recovery, particularly in the euro area, and a less than optimistic outlook for several emerging market economies. Global growth, which moderated more than expected in the first quarter of 2014, regained momentum in the second quarter, although recovery remained largely uneven. The United States provided strong tailwinds for growth recovery, but fiscal constraints continue to limit robust possibilities. Similarly, economic activities in the United Kingdom maintained a strong momentum in the second quarter, supported by improved household confidence and an impressively recovering housing market. Growth in China also recovered following the fiscal policy stimulus and a surge in credit. In contrast, growth moderated in Japan after the value-added tax hike in April, but the quantitative easing program of the Bank of Japan continues to support recovery. Growth in the euro area is expected to strengthen to 1.1% in 2014 and 1.5% in 2015, but will remain uneven across the region, reflecting continued financial fragmentation, impaired private and public sector balance sheets, and high unemployment in some EU economies. In the emerging markets and developing economies, growth is projected at 4.6% in 2014, which is 0.2% point lower than the earlier projection. The sources of growth include strong external demand from the advanced economies. However, tight financial condition is expected to dampen growth in domestic aggregate demand. Global inflation has remained relatively stable, while spare capacity remains large, suggesting no significant inflationary pressures in the short to medium term. The stance of monetary policy has remained unchanged across most advanced and emerging economies in view of the unclear outlook for monetary conditions and financial stability, especially in the post-quantitative easing tapering era. The expectations of increase in policy interest rates remain in focus in the United States and the United Kingdom, even though the Fed reaffirmed that it would maintain the current highly accommodating monetary policy stance. The European Central Bank and People's Bank of China have also announced new monetary stimulus programs which will moderate the impact of the end of the QE3 on frontiers market. The domestic economic and financial developments. The committee noted the continued resilience of the economy as real gross domestic product grew by 6.5% in second quarter of 2014 compared with 5.4% in the corresponding period of 2013. The observed growth rate also surpassed the 6.21% recorded during the first quarter of 2014. The non-oil sector remained the main driver of growth, recording 6.71% in second quarter of 2014, although lower than the 8.21% and 8.88% recorded during the first quarter of 2014 and the corresponding quarter of 2013 respectively. The decline in growth of non-oil GDP was traced to the decline in agricultural output, construction, trade, and services relative to the levels recorded in the first quarter of 2014. The slowdown in agricultural output was attributed to the insurgency activities in the northeastern axis and some parts of the north-central states, which led to displacement of farming communities, thereby limiting agricultural activities and hence output from that region. Growth in the services and industry sectors remained relatively stable compared with corresponding periods in 2013. The committee commended all levels of government and the general population for the coordinated, prompt and effective response to the Ebola virus disease in Lagos and Port Harcourt, two cities that are commercial hubs and leading growth axis for the service and industry sectors of the Nigerian economy. The oil sector grew by 5.14% during the second quarter of 2014, a marked reversal from the decline recorded in the preceding 4 quarters. The committee welcomed the intensification of efforts by government at addressing vandalism of oil facilities and theft of crude oil in the Niger Delta region, as well as efforts towards addressing gas supply shortages to the power plants in Nigeria. The committee reiterated its commitment to continue to support the efforts in addition to facilitating other measures aimed at promoting inclusive, non-inflationary growth in Nigeria. Prices. Headline inflation rose to 8.5% in August from 8.3% in July 2014. The mild but sustained underlying inflationary pressures were attributable mainly to food production and distribution challenges posed by the insurgency activities. From 9.4% in April of 2014, food inflation measured on a year-on-year basis rose to 10% in August, while core inflation moderated twice in 2 months since June 2014. In August of 2014, the year-on-year core inflation was 6.3%, down from 8.1% and 7.1% in June and July, respectively. The committee was concerned that the insurgency was forcing a switching from domestic to imported food to meet domestic shortfall with huge impact on external reserves, and underscored the need to expedite action to restore normalcy to the troubled region to sustain the tempo of growth. The committee further reaffirmed its commitment to sustain efforts at ensuring price stability. Monetary, credit, and financial market development. Broad money supply grew by 2.94% in August 2014 over the level of December 2013, compared with 4.83% in July. The annualized growth of 4.41% in August 2014 was below the growth benchmark of 14.52% for the year. Net domestic credit, however, increased by 5.31% in August relative to the end of December 2013 level. When analyzed, net domestic credit rose by 7.96% compared with the growth benchmark of 28.5% for fiscal year of 2014. The rather slow expansion in money supply in August reflected the 10.17% contraction in net foreign assets of the banking system. Money market rates, interest rates, however, remain within the monetary policy rate corridor, as the overnight and collateralized open buyback rates moderated from 11.3% and 11.49% in August to to 11.08 and 10.62% on 11th of September 2014, respectively. The Monetary Policy Committee noted that both rates traded around the lower band of the MPR corridor on account of the liquidity surfeit in the banking system. Activities in the capital market were bearish during the period, with the all-share index increasing by 4.3% from 42,482 on June 30th, 2014 to 40,672 on September 12th, 2014. Market capitalization also decreased by 4.3% from 14 trillion naira on June 30th of 2014 to 13.43 trillion naira on September 12th. Market indicators declined owing to the profit-taking activities of investors. The external sector development. The average naira exchange rate remained considerably stable in all segments of the foreign exchange market. The exchange rate at the retail Dutch auction system segment was stable at 157.29 naira to the dollar, but depreciated at the interbank and substantially at the BDC segment between July and August 29, 2014. At the interbank segment, the naira depreciated slightly by 32 kobo or 20% to the dollar, 162.4 naira from $1 to 1 naira, 162 naira. Similarly, at the broad exchange market segment, the exchange rate depreciated by 2 naira or 1.2% from 167 naira to the dollar to 169 naira to the dollar. The premium between the retail Dutch auction system and interbank rates was 3.25%, while that between the RDAS and BDC rates stood at 7.45% in the review period. Gross official reserves rose from $39.1 billion at the end of July 2014 to $40.7 billion on September the 17th, 2014. The current level of external reserves provides approximately 7 months of import cover. The committee's considerations. The Monetary Policy Committee expressed satisfaction with the relative stability in the economy, while also noting the risks that lie ahead. The key risks include the possibility of capital reversals as the first quantitative easing in the United States finally ends in October 2014, amidst dwindling oil output and declining oil prices, domestic security challenges, and upward trending headline inflation. The committee further expressed concern about high banking system liquidity and its potential effects on inflation and the exchange rate. The policy challenges the committee noted would include sustaining the stability of the naira exchange rate, managing the vulnerability to capital flow reversals, building fiscal buffers to ensure against global shocks, managing inflation and exchange rate expectations, and safeguarding the financial system stability, as well as build up in election-related spending. The committee welcomed the efforts by government to address some of the constraints and risks to economic activity, like the insurgency in the Northeast and the Ebola virus disease epidemic. It noted that as progress is made in these areas and in respect of other constraints like power and improving SME financing, the outlook for growth appears bright and prospects for upward price pressure will be moderated. The committee further noted that the restrictive stance of monetary policy provided important defenses against structural liquidity in the banking system, and also reaffirmed the willingness to play a key role in managing expectations around exchange rate and inflation vulnerabilities. Consequently, adequate consideration would need to be accorded to goal of reining in banking system liquidity to safeguard the objective of price stability. The committee was, however, concerned that Nigerian banks were holding large excess reserves averaging over 300 billion, even when there were ample opportunities for productive and profitable lending to the real sector of the economy. The concern was further strengthened by the reality of injecting an additional 866 billion naira into the system through the redemption of maturing AMCON bonds in October. Given the apathy to lending, banks may be inclined more to put these new funds in the or use it to increase pressure on the exchange rate. The committee advised the bank to explore ways of encouraging the deposit money banks in Nigeria to lend such excess reserves to the real sector of the Nigerian economy. In the light of the foregoing and consideration of other key risk factors, the committee was of the view that the direction for policy in the short to medium term would be either to retain the current tight stance of monetary policy or further tighten monetary policy. In view of these developments, the committee was split between retaining the current stance of monetary policy and further tightening. Consequently, 6 members voted to retain the current stance of monetary policy, 5 members voted to increase private sector CRR, while 1 member voted to increase public sector CRR. In addition, 1 member voted for an asymmetric corridor around the MPR. Consequently, the MPC decided by a majority vote to 1. Retain the MPR at 12% with a corridor of plus or minus 200 basis points around the midpoint. 2. Retain the public sector cash reserve requirement at 75%. And 3. Retain the private sector cash reserve requirement at 15%. I thank you all for listening.
Ladies and gentlemen, we have heard the presentation of the MPC Communique by the Governor. You indicate if you want to ask questions, and please let us remember the ground rule that questions and comments have to be limited to the subject matter of the communique. Thank you. Any questions? Yeah, please.
Mr. Governor and other members of the committee, my name is Emefiele. I work with Bloomberg TV Africa. I have about 2 questions for you. The first one is that do you have a timetable for interest rate easing between now and the next 12 months when you expect the US Fed to start its own quantitative easing? So is there a timetable on the MPC, for the MPC? The second question goes to the issue of liquidity in the banking system. And the key question is, those concerns making rounds about the exposure of the local banks to the oil and gas and power sector, do you have what it takes if there's a need for another too big to fail scenario? Will you intervene? And how will you intervene if you're faced with a too big to fail scenario in the near future? Thank you.
Good afternoon, Mr. Governor. My name is Emefiele, and I work for Bloomberg. Just to add a little bit to what my colleague from TV has said, basically, my question has to do with what are some of the preconditions or signs that you will see that will lead to easing of the MPC?
no other questions means the communique is well understood. Mr. Godwin.
Well, thank you very much. The first question talked about the timetable for interest rate easing in Nigeria. What we are seeing is that what's our plan to begin to bring down interest rates? Well, basically, I think the issue is that I will still repeat myself that the decision to bring down interest rates depend on the size of liquidity and all economic parameters in the Nigerian economy, particularly as we move and as we approach the election. You must you heard me talking about the high level of liquidity in the system. The Monetary Policy Committee thinks that although the natural direction is to tighten, but we still felt that if we cannot reduce interest rates, we should just leave it stable rather than taking it up. Just primarily because we believe that increasing interest rates will hurt our people. It will lead to some of the companies will begin to complain that the high interest rates will hurt their business, and for that reason we decided to leave interest rates stable. Ordinarily, because of the size of liquidity that we see in the system today, what we should have done actually is to tighten further. But we will continue to monitor the liquidity system, and I can assure you that what we have in our agenda that says that interest rates will gradually come down is an objective that we would eventually pursue, but we will continue to monitor what is happening in the Nigerian economy and all the parameters to be able to determine whether or not we have attained the right time to move in that direction. Now, liquidity in the banking system, we talked about maybe threats, particularly in the oil and gas, as well as the power sector exposures. Yes, the committee reviewed indeed exposures to the oil and gas power sector, and after we disaggregated the numbers, we found out that those exposures were going primarily to companies that acquired oil blocks in the upstream sector. We think that giving Nigerian banks the opportunity to begin to lend money to companies in the oil sector, in the upstream sector of the economy, is a good one, and we have not seen any risk of failure to repay those loans, particularly because these companies generate foreign currency revenues, and we believe they will be able to meet their obligation. The exposure to power sector is also another aspect that people are a little bit worried about. But let me say that there is truly no need for anybody to worry about the exposure to the power sector. And that is the reason why the Central Bank of Nigeria, in collaboration with the Nigerian banks, are trying their best, also working with the Ministry of the Petroleum Resources, with the Ministry of Power, as well as the Nigerian Electricity Regulatory Commission, working hard to see how the legacy debt in the power sector will eventually get paid. As these debts get paid, what you will find is that the gas price has been made commercially viable, and there is also the intention to ensure that the mine to 2.1 is also improved to also make it profitable for people to be in that business. So what you will find effectively is that as the mine to becomes commercially viable, certainly we believe that the discos and the gencos that have borrowed money for acquisition, and indeed some of them that may have also borrowed money to acquire assets and all that, they should be able to pay their debts, and we do not foresee any risk of not repaying the debts. We are monitoring the numbers very closely, and we are pretty much optimistic that we will not face the kind of risks that we are all anticipating. You talk of signs to easing in the system. We are going to continue to monitor what is happening in the environment. Like I said earlier, what we have seen is that instead of banks channeling what we call excess liquidity in the system into the productive or certain targeted sectors of the economy, what the banks are doing is placing this money either in treasury bills or even investing them at the CBN window, at the CBN SDF window. We are going to be advising and appealing to the banks, and we are even indeed seizing this opportunity to do so. We will be looking at opportunities for easing as we arrive at that bus stop. But at this time, we have not seen that, and particularly as we approach the election, we are not seeing that. We are hoping that maybe after the election, situations will improve. We are monitoring all the parameters, and again, we are pretty much optimistic that we'll begin to see green light at the end of the tunnel. Certainly, we'll begin to move in the direction of lowering interest rates. I thank you very much for your question.
Thank you, sir.
Does it?
Yes.
Thank you.